Let's talk about Globus marketing. Globus marketing decisions should probably be your first decisions and leading into the whole or impacting the rest of the decisions you have. So I recommend that you look at marketing first. Marketing determines your market share, how many items you sell, obviously, but depending on the decision, one marketing decision might affect um, other aspects of your business, increasing or decreasing costs. So you have to understand all of the interrelationships there. Now, in Globus, there are multiple markets, 4 regions, 2 products. So that's about 8 domains you can consider. And you can concentrate on one domain or another, or try to market in using the same strategy across domains. Key driver for sales is going to be price versus PQ. When you go to the store, you're looking for the lowest price for the quality you're interested in, and that's what everyone else is looking for too. So, what is your ratio between pricing versus PQ? You want to take a look at that. And at the bottom of this screen, you'll see the bottom right hand side of the screen over here. You have your competitive assumptions, and what they mean there, that's the industry average, the anticipated industry average. So you look at your price, $485, versus the industry average, which is $392. Your PQ, 5.8 versus 4.1. So your PQ and price are higher. And what you might want to do is calculate the exact ratio there. But if your PQ and price ratio is better, then you're going to sell more. You also have number of models, which we'll talk about before. The number of models gives you your customers more options. Obviously, that's going to lead to more sales, and we're going to talk about later on how that actually causes a lot of costs and production issues for you. Obviously, we're also looking at retail support budgets, so you're setting up displays in stores and anything associated with trying to get your products on the shelves of stores would be involved with that. Obviously, advertising, website displays, sales promotions, all of these things have a cost to them. And then warranty period, we'll talk about a little later. Depending on the warranty period, that's going to impact your expected claim rate, which is going to increase your costs. So you're going to sell more, but your costs are going to be higher, and you got to balance that out. One advantage to earning market dominance is actually once you get market dominance, then your costs will be lower for marketing. In other words, you could spend less on marketing and still maintain that, whereas to gain market dominance is actually going to cost quite a bit of your cash. And as you can see, there are, here are your 4 regions that we're working with. We have price, model, and the budgets. And down there, a market segment stats, giving you an overall idea of what your demand is and projected demand is, and projected market share, and number of multi-store chains, online retailers, local retail shops, etc. So those are your projected figures. That's not necessarily what you're going to achieve. Competitor decisions could change that. And this will be the bottom of the screen again. You're looking at the way of comparing what you're doing to others to see if you want to move the needle, increase your market share. You'll want to actually have a better price, better PQ ratio. You might want to have more models, and then all of these other items should be a notch above competition. The comparative competitive efforts report is something that should be kind of your Bible. You should be looking at this every turn and doing studying this. You can see everything's laid out for you. It's easy to compare the marketing efforts, price and PQ in this chart. In addition, you'll also see towards the bottom the gained loss line, third line up. And one thing you want to notice about that is whether you are actually meeting demand. Now, company B is not, so they actually have probably enough of a um, investment in marketing or a very good price and PQ ratio, perhaps. So they have lots of demand, but they neglected to make sure they can make those products. So they're leaving dollars on the table, which is not a good thing. And when you don't meet demand, then other people, your competitors, and you're directly competing with everybody else. You're not only losing your thing, but you are also giving to your competitors. So you're actually losing twice. So you want to keep that in mind there. And then, of course, market share is something you want to pay attention to. Over here to your right is going to be your figures versus the industry average figures, and it looks like your price is 9.3% below market. Quality is a little bit more, about 12% below market. So your price and quality ratio is not all that good because you're actually offering a less quality than for the price. So I would break out a spreadsheet when using Globus and do exact calculations. That means just a simple ratio. Basically, in this case, you're looking at company A is charging $340 and their PQ is 5.2. If you do the ratio, it's about $65 per PQ point, whereas company B is offering something that's $73. And so, company A is going to be more competitive. And you can see the differences over there. You can eyeball it, but you can also use a spreadsheet to get exact ratios, which might be a good idea. Marketing is interrelated with other decision screens, and this is important. Every time you make a decision, there might be impacts elsewhere, and you need to understand that and manage that. Otherwise, you're going to lose the game. You might sell more items and have more market share, but your costs might increase so much you could actually lose profit. So if you decide, for example, that you want to on the design screen increase the number of models, because that will actually increase your market share. Giving people more choice obviously is going to make your products more attractive, but at the same time, what that's going to do is make it harder for your workers to produce those products, decreasing productivity, increasing labor costs. You're also going to increase reliability problems. You're making it more complicated for the workers, and so they're going to make more mistakes. And the lower quality of your products and less reliable product is going to lower your PQ rating, your quality rating, your reputation, and your image. So you'll see that if you look at the design screen, it's going to tell you the projected unit assembly. So when you change the number of models, you'll see those numbers down there changed. And you'll be able to quickly assess what the impact will be. If that impact does not look good, then you need to go to the compensation and facility screen and see if you can find a way of increasing productivity. Always you have to look at whether you can pay for what you're interested in. So any investment in marketing is going to lead to a need to come up with financing, and that can come from cash, or that can come from loans, that could come from issuing stock. And all of those things you should have a strategy for. You should know what you want to do financially, because those are also deeply intertwined with victory conditions like credit rating, and your EPS and ROE are impacted by those things. So you want to make sure you can maintain your finance and cash flow strategy, and you want to check whether at the end of the day, after making all these decisions, what that final number is, whether you're going to actually have additional cash, or if that number is red, that means you're going to be, you're actually not able to pay for everything that you decided to do. And what that means is the game is going to automatically take out terrible loans that you don't want. So what you would want to do is either pare back some of your expenses so you don't have that negative number, or what you want to do is go ahead and take out a loan or issue stock or something like that, rather than having the program take out terrible loans for you. The impact of increasing or decreasing warranty on the marketing screen, it gets pretty complicated too. So if you increase warranty, obviously you're going to be more competitive. People are going to buy your product, but at the same time, what that means, longer time that customers can return the product, that means more product is going to be returned, and that's a cost. And as you can see, there's at the bottom line in that picture of the decision screen for the marketing is the expected claim rate percentage and repair costs. So 20.5% and $4,530. So you have to look at how much profit you'll make by selling more, and then also look at the cost and see if it's worth it. Now, what you can do is manage those costs by going to the compensation facility screen and increasing the reliability of production. And you can do that by increasing R&D, increasing training. And in the design screen, you can actually decrease the number of models you have, which will do a couple of things. But one thing it'll do is increase your reliability, and it'll also help you with production efficiency, and will actually help your PQ as well. Overall, the most important factors, according to the participants guide, is price and PQ. So you should be laser focused on that. What's the ratio there? And also, moderately important factors going to be the number of models, warranty length, promotion, brand reputation, what was last year's market share, what is the PQ, and what is your branding through the corporate social responsibility screen. In addition, the least important factors are going to be retailing, website advertising, search engine traffic, third-party online retailers, things like that. So keep that in mind. What's important, what's not important, or less important for marketing. So again, I would start the game with the marketing screen, and those decisions then flow into a need to work on some other screens. So the compensation and facility screen, you'll need to see if you can meet demand. It's going to show you estimates of what the estimated demand is, and show you how much you can make at this point. If you increase the warranty, you want to manage the cost of returns, like we talked about. If you increase the number of models, that's going to have an impact that we've already talked about on a lot of different areas. The design screen is where you're going to change actually the number of models, but that is also where you can manage PQ, and PQ is important in terms of your main ratio there, which is price and PQ. Corporate social responsibility and marketing does impact image. So if your market share is suffering, you might want to invest in corporate social responsibility. And then obviously always you're checking to see if you can pay for everything in the finance and cash flow screen. Okay, some opportunities in marketing are selling more units, obviously. increasing your image, because if you have greater market share, you're going to increase your image. And another opportunity is to gain market dominance, which is going to reduce your ongoing marketing costs. Maintaining your market position costs less than trying to, earn greater market, position. Demand. Some threats include not being able to meet the additional demand that you've earned through investing in marketing. And if you want to go the more models route, you have to manage that, as we talked about. And if you want to increase warranty, you're going to have to manage the reliability concerns. Okay, let's jump into the game itself. Here you could simply change some of these values. As you change the values, you're going to see other numbers on the screen change, giving you information about the impacts. So if I went and I said, okay, I want to increase the price from $4.90 to $4.50 there, and you'll notice over here right now the earnings per share is 27.49, and I press enter on that, you'll see now it's 28.80. So the projected performance impact projections are going to be right there. Those are not guaranteed, but it gives you some idea of the impact. And you can see the number of models here, and a lot of other choices you have down below. You want to compare, of course, you want to make these decisions about price and PQ in relation to the industry standard, and that's the industry average, and that's going to be down here. As you make changes here, warranty period, let's say, for example, it might impact things elsewhere. So that price is going to impact of the warranty period. It's going to increase your expected claim rate and your repair costs. Now, you may then want to manage that. You may then want to go to the compensation and facility screen and increase the reliability of your products. You would do that by investing, let's say, in best practices for training. You might also pay the workers more. Hopefully they'll make fewer mistakes if you do that. And in addition, want to go to the product design screen and maybe increase R&D. So R&D might be able to help with the reliability of that as well. If you go into the number of on this design screen and actually change the number of models, that is actually going to impact several things. Well, one thing it's going to do is 7 models, which is probably the max here, is going to give you a competitive edge, and you'll probably sell more items. But at the same time, what it's going to do, it's actually going to decrease your PQ rating. So it's going to make your product less attractive. It's going to have a reputation for bad quality. So what you may want to do is lower that. If you do, then what's going to happen is your PQ will increase, and probably your productivity will increase quite a bit as well. So what you would do is look at the projected unit assembly, and as you can see, with one camera here, you have a total of 1,700 cameras that can be assembled.